It is the 21st of December 2021. My name is David Hickson, and in today's market update I'm going to be taking a look at the S&P 500 and also Bitcoin, discussing what happened in 2021 and saying goodbye to 2021 with a little bit of relief, and looking ahead at 2022 to see what the cycles should bring us next year. I must apologize for the fact that I didn't produce a video last week. My main computer that I use for recording these videos started emitting smoke through its side vents. Well, it didn't actually, but effectively it stopped working, and by the time I had replaced it, I had caught a cold. Nothing more serious than a cold, but it is unfortunately going to affect my voice slightly, so I apologize if my voice gets a little husky in the course of today's video. But that is why there's been a little bit of a delay in bringing out this wrap up for the year. So let's take a look at the S&P 500. Now, in recent market update videos, we have been tracking three different analyses. One of those is the analysis that I call the default analysis, because it is an analysis that I have not influenced at all. Sentient Trader is a very powerful piece of software, but it is a tool in the hands of an analyst. And so it's important that you, as the analyst or trader working with Sentient Trader, influence the analysis to make sure that you are getting an expert analysis out of it. I always track a default analysis because Sentient Trader has often proved me wrong in terms of producing a better analysis than the one that I believe to be true. But at the moment, I must say I am in disagreement with Sentient Trader's default analysis. And I should point out that if you are working with Sentient Trader, you might be looking at a different default analysis. There is not a global default analysis, as it were. It all depends on the amount of data that you're showing Sentient Trader, how much data you tell it to analyze, what nominal model you're working with, what the history of the analysis is, because Sentient Trader does what Hurst did 50 years ago. It updates its analysis each day, and so the analysis becomes a work in progress, as it were. It's a developmental process. So you might be looking at a slightly different default analysis. But nevertheless, this is the analysis that Sentient Trader is providing us with by default, which presents an 18-month cycle trough over here at the beginning of December. Now, if we measure the number of bars, you will see that makes it a fairly long 18-month cycle trough, which I have a bit of a problem with. It's not impossible. It's 620 days or 20.4 months. Now, the average length of an 18-month cycle, as discovered by Hurst 50 years ago, is 546 days. If you don't understand why that is, then I would encourage you to download the 10 core concepts of Hurst cycles document, which I will provide a link to below this video. And so this is a long 18-month cycle, of course. It's about 60 days long, or 56 days long. And that is not impossible because of the principle of variation, which tells us that the wavelengths are constantly changing. They are dynamic. They are not absolutely fixed, but over time they average a certain amount. And so a long 18-month cycle of 620 days is not impossible. However, following an important trough, which we definitely experienced in March of 2020, I don't think anybody debates that. Following an important or big magnitude trough in March of 2020, we would expect troughs of cycles to occur early. It's not a principle, but it's another of Hurst's tenets, if you like. When you have a bullish market, troughs tend to occur early, as opposed to occurring late. And so it is a little unlikely to witness an 18-month cycle trough following a really big magnitude trough coming in that late. Not impossible, of course. This is as much an art as it is a science, but certainly that position at the beginning of December is not the best one, in my opinion, for the 18-month cycle trough. Where is a better position? Well, you will know if you've been watching these market update videos that I have been discussing the early October trough as a possible position for the 18-month cycle trough. And I have also been considering a trough in the middle of July. I think it's that trough over there as a possible position for the 18-month cycle trough. So I'm going to show you analyses considering both of those options in a moment. But let's just consider the position, first of all, of the trough in October. You can see that there were 558 days that elapsed from the March 2020 trough to the trough that formed at the beginning of October. I've already mentioned the average length of an 18-month cycle is 546 days. So that trough occurred only 12 days late. That's much better, in my opinion. It's a much better position for the cycle trough to have formed. Why hasn't the default analysis of Sentient Trader, this expert analysis software, positioned the 18-month cycle trough there? That's a very important question, and I'm glad you asked it. The answer has to do with the way in which a Hurst cycles analysis is performed. You don't simply look at the number of bars or the amount of time that has passed and then position the cycle trough there. You have to solve the puzzle of the way in which the shorter cycles are all fitting together. You must remember the principles of harmonicity and synchronicity tell us that the troughs of the cycles are synchronized where possible. And that is why we have these piles of diamonds at the foot of the chart. Each one of these piles of diamonds represents the position of a synchronized trough. And so simply counting the number of bars that have elapsed when positioning the 18-month cycle trough is not a very good approach to performing your analysis. What is more important than the number of bars that have elapsed is the way in which the analysis breaks down to the shorter and shorter cycles. Yes, all the way down to the 5-day cycle if you are looking at daily data. And so that is why the default analysis has not positioned the trough there in October. And when we take a look at an analysis that I have produced that does show the trough there, I can explain some of the difficulties of positioning that trough over there. The third possibility, as I've mentioned, is the idea that the 18-month cycle trough formed here in the middle of July, and that would have been an early cycle trough, but as I've mentioned, following a very big cycle trough in March of 2020, we would expect an early cycle trough to form. Why is that still an analysis that I consider, given the very small blip in the financial markets that formed at that time? There are two answers to that. One has to do with the breakdown of the analysis in the shorter cycles, which we will see in a moment. But the other answer, and perhaps a better answer, has to do with the fact that other markets around the world were forming more prominent troughs at that time, such as the FTSE, for instance, which we're not going to look at in today's video, but I have discussed the FTSE in previous market update videos. And the FTSE clearly formed a very important trough in the middle of July, and Bitcoin, which we are going to be looking at in today's video, also formed a very important trough in the middle of July. You might say, what does a trough in Bitcoin have to do with a trough in the S&P 500? Another good question. And the answer to that lies in the principle of commonality, which is one of Hurst's principles, which tells us that all financial markets move with a great deal in common. Now, Bitcoin is not a stock market, but Bitcoin is a holder of value, if you like. It's effectively a currency. It is a holder of value, and stock markets are in a similar way a holder of value, slightly different of course because they represent industry and companies and so forth. So it's a different holder of value, but nevertheless a holder of value. And any holder of value will tend to be influenced by these cycles. So that's a complicated discussion for another time. So this is the one analysis with the 18-month cycle trough in the beginning of December. Let's take a look at the more likely analysis, which has the 18-month cycle trough over here in the beginning of October. Now there is that 18-month cycle trough over there, beginning of October. You will notice that I have had to influence this analysis. That's what these pin symbols are. I have pinned these troughs there. It's a simple process whereby I suggest to Sentient Trader that it positions the troughs in those positions. Why have I pinned two of them? Because, as I have mentioned, an important part of the analysis is the way that the shorter cycles break down. What is the position of the shorter cycle troughs? You can't just look at the 18-month cycle trough. You need to look at the 40-week, the 20-week, the 80-day, the 40-day, the 20-day, and so forth, all the way down. And you can see that I have had to position the 40-week cycle trough at this very questionable position over here in order to achieve an 18-month cycle trough over here in October. Now, you could get a little more detailed in terms of the analysis and possibly position the 40-week cycle trough over here or over there. I did explore the possibilities, and every now and then I like to wipe the slate clean with an analysis and just get in there again under the hood and explore the possibilities. And I did that again in order to produce this analysis, and this was the simplest way of producing that 18-month cycle trough over there. So although the position of the 18-month cycle trough, in my opinion, looks very good, there are questions about the position of the 40-week cycle trough and the breakdown of the shorter cycles. For instance, we have a very short 20-week cycle over there and a very long 20-week cycle over there. So there are some details to the analysis that are not perfect, but nevertheless it produces a result that is very useful in terms of us making trading decisions, and particularly being able to anticipate what is happening next. And one of the reasons that I say that this analysis is particularly useful has to do with these very neat nests of lows. Nests of lows are, of course, where we are expecting troughs of next cycles, or the next trough of particular cycles, to form, and they tend to form with these circles lined up on top of one another. When you've got a very consistent analysis, you get these very neat nests of lows, and so that provides us with very useful information. And when you get very neat nests of lows, it is sometimes an indication that you have a very good analysis going. And so this is certainly a very viable analysis, possibly my preferred analysis at the moment. Let's go and look at the third analysis here, which was for an early formation of that 18-month cycle trough. As I have already mentioned, here in the middle of July, you can take a look at the market update videos that I have been making pretty much ever since that time, and even a little before, I think, when we were anticipating that 18-month cycle trough. You can see I have had to influence this analysis as well. Doesn't mean there's anything wrong with it, but the influencing that I have done is it makes a little more sense, in my opinion, than the other analysis we were having a look at. I'm not going to go through all the details of this analysis. We've discussed it at length in previous market update videos, but you can see that most of these cycle troughs that we have identified in the analysis are fairly clear cycle troughs that actually formed in the markets. Now, this analysis positions the 80-day cycle trough here at the beginning of October, and of course the 20-week cycle trough over here at the beginning of December, as discussed in recent market updates. So, what do these three analyses tell us to expect in terms of looking ahead? First of all, let's wrap up 2021. What has happened in 2021? Let me go back to what is probably the preferred analysis at the moment, which is this one over here. What has happened in the course of 2021? The most important thing that has happened is that we have witnessed the formation. Although we are in some doubt as to where the trough formed, we have witnessed the formation of the trough of the first 18-month cycle following a big magnitude cycle trough in March of 2020. That trough was of at least 54-month magnitude, possibly 9-year magnitude. I'm not going to discuss the ins and outs of that at the moment, but certainly it was a big magnitude cycle trough. And so that has been the important event, really, of 2021. Was it a big surprise that this was a very bullish move? It doesn't take a rocket scientist to identify the fact that that was a bullish market during 2021. It was not unexpected. Following a big magnitude trough in March of 2021, the shape of the first 18-month cycle is expected to be very bullish, right? Because we have long cycles that are pushing upwards. Possibly the 9-year cycle has been pushing upwards, and almost certainly the 54-month cycle has been pushing upwards. So that is really the bigger picture for 2021. We saw a bullish market, no big surprise there, and we saw a fairly subtle 18-month cycle trough. Again, not very unusual, the fact that we saw a subtle 18-month cycle trough. That first trough of the 18-month cycle following a big magnitude cycle trough in March of 2020 probably will be a fairly subtle one. So what are we expecting looking ahead? Now this is where it gets interesting, and we're going to take a look at each one of these analyses and consider what that analysis tells us to expect. So the first thing that we are expecting, let me drag this chart over and let's zoom in, and let's go in from about there to there. Okay, so here we have 2023 lying ahead of us. What are we expecting? Well, in fact, I should probably zoom out just a little here. There we go, so that I can see that 18-month cycle. We are now in the second 18-month cycle of the current 54-month cycle. What is the second 18-month cycle expected to give us? It is expected to be less bullish than the previous 18-month cycle. I hope that you understand that. Let me draw a quick diagram. Here is a 54-month cycle. Within that 54-month cycle, we are going to witness 3 18-month cycles, okay, which are going to manifest in the price action as a very bullish 18-month cycle, a fairly neutral shaped 18-month cycle, and then a bearish 18-month cycle. I hope that makes sense. And so we are now here. Okay, price has recently bounced out of an 18-month cycle trough. We are moving up in that 18-month cycle, and then we are going to turn around and we are going to move down, and that cycle is expected to be less bullish than the previous 18-month cycle. So that's the bigger picture. That's what we're expecting. We are now moving up, and then we are going to see a less bullish 18-month cycle form, and the next 18-month cycle trough, according to this analysis on our charts at the moment, which is with the trough in October of 2021, here is the next 18-month cycle trough, which is expected in early 2023. So I have just drawn a very rough diagram. I'm now going to use the composite model line, which is a very useful tool in Sentient Trader, to give us some idea of what we can expect using the analysis information on the chart. And there is the composite model line. So I must explain a few things about the composite model line. I've mentioned this often. The composite model line takes the information from the analysis in terms of the cycle wavelengths and amplitudes of every one of the cycles found in the analysis, and it recomposes that information to produce the composite model line. And the composite model line makes some assumptions in terms of cycle wavelengths continuing to beat with their current wavelength, with a gradual return to the average wavelength of each of those cycles. And it also assumes that the amplitude of those cycles are going to continue to be consistent. Now, those are flawed concepts because of the principle of variation. The wavelengths are constantly varying, so these wavelengths are going to change. And the thing that is going to change even more than the wavelengths, in my experience, is the amplitude of each one of those cycles. So we are going to see a different price action to the dashed line that you see on the chart in front of you. But it does give us a very good idea of what to expect, particularly in terms of the structure, by which I mean when the market is expected to be going up and when it is expected to be going down. That's what I mean by the structure of the market. Don't take the price levels too seriously. The reason for that is because the amplitudes of the cycles vary very greatly in my experience. And when an amplitude varies, price targets are not met, or the amplitude is of course measured in terms of price movement, and so the price levels are the least accurate part of the composite model line. But the composite model line does give us a very good idea in terms of what we can expect over the next year. So as I have mentioned, we are expecting a less bullish 18-month cycle. So here is the trough in October of this year. Here is the next trough of the 18-month cycle according to this analysis, which is in a lower position in early 2023. So as mentioned, we are still expecting price to move upwards. The big event in 2022 is really the formation of the 18-month cycle peak. And then of course the market's going to turn down and move down into the trough. But I should point out that this composite model line includes something called sigma L. Now, sigma L is the sum of all cycle information, if you like, longer than the longest cycle found in the analysis. How does that work? Well, Sentient Trader takes a look at the price action and it uses the results of the composite model line in terms of what happened in the past, and it looks at the difference between price action and what the cycles were doing, and it assumes that that difference is created by cycles much longer than the longest cycle found in the price action. I'm speaking about a very slow moving influence, of course, but sigma L is speculation at best. And this is based on Hurst's original writings about sigma L, and Hurst indicated that sigma L tends to turn very slowly. An interesting thing is happening in this market at the moment. Sentient Trader has picked up signs that seem to indicate that sigma L is beginning to turn down. That's really interesting, and I could spend many hours just talking about that, and I probably should make a video just about that concept, but we don't have time to discuss it in detail now. The important thing, in my opinion, is that there's a large amount of speculation involved in that. Sentient Trader is measuring the difference between what the cycles were expected to do and what they have done, and it has begun to detect a weakening of sigma L's influence on the financial markets. But in terms of our looking ahead over the next year, a very sensible thing to do then would be to ignore sigma L, which we can do. So I'm going to turn off sigma L. And by ignoring sigma L, you will notice that our 18-month cycle is not quite as bearish as it was expected when we included sigma L. So we still have the same general structure. We have a move up. We have the formation of an 18-month cycle peak sometime in 2022. When we ignore sigma L, which I should point out again is fairly speculative, when we ignore sigma L, we have a later peak to that 18-month cycle. So that's something to watch out for. If sigma L is turning down, we would expect a slightly earlier peak. But if sigma L is not turning down, the 18-month cycle peak will occur later. We'll be watching out for that next year. And then the move down into the end of 2023 and into this 18-month cycle trough in early 2023 is then likely not to be quite such a strong move down. We are certainly going to end up with a less bullish 18-month cycle, as mentioned and as expected, but it might not turn out to be a bearish 18-month cycle. However, if Sentient Trader's detection, or I should say early detection, of the possibility that sigma L is turning down turns out to be correct, then we might witness the markets beginning to turn a little bearish during the course of next year. Let's take a very quick look at the other two analyses in terms of what we're expecting next year. Here is the default analysis, which, as I've mentioned, I have some questions about. I'm not going to spend too long discussing it. You can see that the general idea is that yes, we are moving up following a trough of the 18-month cycle. Again, a questionable position for that 18-month cycle trough, in my opinion. Here we are expecting a late peak of the 18-month cycle to form sometime a little after the middle of next year, after which price is going to move down and form, in terms of this analysis, because the cycles are running much longer, not an 18-month cycle trough, but a 40-week cycle trough, which is expected sometime towards the end of next year. This, in my opinion, is not such a good analysis, so I'm not going to focus too much on this particular analysis, but I should point out that in terms of the finer details, there is not a huge amount of difference. We have an 80-day cycle trough in February, and then we have a 20-week cycle trough over here sometime in May. Those are those troughs over there. And then we're looking at a peak forming sometime in late June. Remember those dates, hold on to them, because we're going to come back to the other analyses and take a quick look at what they tell us to expect. Here is the third analysis with the early 18-month cycle trough in the middle of July. I quite like the way that the composite model line is working according to this analysis. You can see it matches price action fairly well. You can see that we are still in our upward movement following the 18-month cycle trough, although that upward movement is a little more mature according to this analysis. And I should point out here again the 80-day cycle trough that is expected to form in February, and the 40-week cycle trough that is expected to form in April, exactly the same as we were looking at in the other analysis. I hope you're beginning to see how, even though we have different analyses, some of the details of what we're expecting are fairly identical. And then we are expecting a peak of the 18-month cycle trough to form over here. That's in about June of next year. And then, of course, the 18-month cycle is expected to turn down and come down to form an 18-month cycle trough. There's a bit of a staggered nest of lows over here, but you can see it's expected in early 2023. Now, I should point out that here too, Sentient Trader has detected that sigma L is beginning to turn down, because when I turn off the sigma L contribution to the composite model line, you can see that, of course, we are still expecting an 18-month cycle peak to form, but it is not expected to move quite so far down into the 18-month cycle trough expected in early 2023. So that is really what we are expecting in the S&P 500 and in stock markets pretty much around the world. Of course, there will be differences in different countries, but generally the big event, in my opinion, that we are looking for in terms of next year is the formation of an 18-month cycle peak. And then, of course, price is going to turn down to form a less bullish 18-month cycle towards the end of next year or early 2023. Now, before we move on to Bitcoin, just a quick further comment about the S&P 500 in terms of what's happening in the nearer term. You will know from the other two analyses that we looked at that in February we are expecting a trough. In the other two analyses, that trough was of 80-day magnitude. In this analysis, we are also expecting a trough in February, but this trough is expected to be of 20-week magnitude. So it'll be either 80 days or 20 weeks. We're going to watch with interest. But I would like to point something out, which is that cycles form M shapes in markets. And an interesting thing has started to develop. I am always on the lookout for some symmetry in markets. And there has recently been a slightly bearish symmetry forming. Can you see that I am there beginning to describe an M shape? Is it possible that the peak that we saw over here, and that was just last week, is it possible that that is the peak of the current 20-week cycle according to this analysis? It is possible, in which case we're going to see a fairly bearish move as price comes down to form this 20-week cycle trough in February. So this doesn't discount what I've said in terms of the bigger picture. We are certainly expecting price to move up and form an 18-month cycle peak, but we might be in for a little bit of turbulence as price comes down into the trough in early February. And we are keeping a close eye on that. Let's take a look at the 20-day FLD. The 20-day FLD, you know, is a very useful FLD that we use to track the interactions between price and the FLD to help us to make trading decisions, but also to clarify the analysis and to identify trading opportunities. Following a trough of at least 80-day magnitude, so whether this was an 80-day cycle trough or a 20-week cycle trough, or indeed even an 18-month cycle trough, we expect price to cross up above the 20-day FLD in an A category interaction. We expect it to come up and achieve its target. I believe it didn't quite achieve its target. I haven't actually measured it. It was fairly close, but the more important thing that has happened since then is the price came down to the 20-day FLD. And the next interaction that we expect is what I call the BC category interaction. The B category interaction is where price finds support at the level of the 20-day FLD. On, what was that, Wednesday and Thursday of last week, it looked as if the price was finding support at the level of the 20-day FLD. But on Friday, it crossed down below it. We have this developing symmetry, as I've already pointed out. And we are expecting the 20-day cycle trough to form about now. But the fact that price has dropped below the 20-day FLD and formed a potential 20-day cycle trough over here, it might still lie ahead of us, but you can see 18 bars have elapsed. The average length of a 20-day cycle is 17.1 days. And so that the time is absolutely perfect for a 20-day cycle trough to form. And if that 20-day cycle trough does form down there, it is of course lower than the 20-day FLD. That is a bearish sign. It's a bit of a bearish warning. So even though the 18-month cycle trough is fairly recently behind us, we need to be careful of the markets turning bearish for the move down into the February trough. Now let's take a quick look at Bitcoin, and I am looking here at a logarithmically scaled chart. As I've mentioned, when you scale Bitcoin using a linear chart, all the price action before 2017 is just a squiggle at the bottom of your screen. It's not very useful. So if you look at it using a logarithmic chart, it's much easier to see the formation of the peaks and so forth. And this is, again, a default analysis in terms of the peak analysis. The trough analysis I have influenced ever so slightly by moving the 18-month cycle trough just a little bit later, as I've discussed in previous market update videos. The important thing in terms of what's happening to Bitcoin is the formation of this recent peak over here. We have been discussing it in recent market updates as a peak of at least 80-day magnitude. In my most recent market update about Bitcoin, I discussed the possibility it was an 18-month cycle peak. It is also possible, as shown in this analysis, that it is a 54-month cycle peak. Now that, of course, will provide us with some bearish consequences, because if we have witnessed a 54-month cycle peak, then of course the 54-month cycle, and in fact let me plot some semicircles on here instead of drawing them, the 54-month cycle is going to be influencing price to move downwards. There is the semicircle for the 54-month cycle, which you can see is influencing price to move downwards. Now, I am not convinced that the 54-month cycle peak did occur over there. One of the reasons is because if we count the number of bars that have elapsed, there have been only 1434 bars or days or 47 months. That's fairly short for a 54-month cycle. And so I wouldn't be surprised to see the 54-month cycle peak still lying ahead of us. Another reason is because of what happens when you take a look at the finer detail of the analysis. In particular, this 18-month cycle peak over here really doesn't look very good to me at all. At the moment, the trough analysis seems to be working better in Bitcoin, in my opinion, than the peak analysis. But we cannot ignore the possibility that a 54-month cycle peak has recently formed. So we need to consider what is happening now. Let's take a quick look at that peak, at the trough analysis, I beg your pardon, and discuss what's happening in the trough analysis. Here is the 18-month cycle trough, which formed in the middle of July, as I've already discussed, and I've mentioned it in previous market update videos. We had a slightly lower price, of course, over here. The reason I've pinned this trough is because Sentient Trader preferred to position the trough at this lower price over here, but I think this is a bit better position for it over here. We have a probable 20-week cycle trough, which formed over here, as you can see, in early December. 137 days after the trough in the middle of July. Now, the average length of a 20-week cycle is 136 days, as discovered by Hurst 50 years ago. That kind of thing gives me warm, fuzzy feelings. Isn't that extraordinary that a cycle that was discovered by Hurst 50 years ago potentially forms a trough only 1 day later in an instrument that many people like to consider isn't really influenced by the same influences that affect traditional financial markets. Bitcoin is very clearly influenced by the same cycles that we see influencing other financial markets, as discovered by Hurst 50 years ago. However, the actual position of that 20-week cycle trough is a little questionable. We had a strong move down and then a bounce straight back up again. So, in fact, that might not be the best position for the 20-week cycle trough. Nevertheless, the 20-week cycle trough is certainly forming either there or perhaps it has formed recently. I'd like to point out in Bitcoin, again speaking about the similarities between stock markets and Bitcoin, we have a trough expected in February. an 80-day cycle trough. Isn't that interesting? We're also expecting an 80-day cycle trough in the S&P 500. And here in April, we have a trough of 40-week magnitude. Again, a lot of commonality with the S&P 500 analysis we were looking at a moment ago. So what are we expecting for Bitcoin for the year 2022? Let's zoom out a little and consider what we are expecting. So here is the composite model line over the next year for Bitcoin. And of course, we have a trough coming up in February, and we have another trough coming up in April. The big difference, as I think you can see here, is that in Bitcoin, it seems very likely that the 18-month cycle peak is now behind us, whereas in the S&P 500, we were looking at the 18-month cycle peak occurring later. We are expecting a peak in price to occur in Bitcoin, and it's expected at about the same time, interestingly, in about June or July of next year. According to this analysis, that is only a peak of 40-week magnitude. Now, of course, this is the analysis that assumes that the 54-month cycle formed a peak in, where was that? That was in November of this year. And so if a 54-month cycle peak has formed, then of course that's influencing price to move down. And so the upward move out of the 18-month cycle trough is most likely behind us. And so 2023 for Bitcoin, according to this analysis, is going to have some upward movement, but is mostly going to be a downward affair into the 18-month cycle trough expected towards the end of next year. But let's take a look at the other analysis. In this analysis, as you can see, I have pinned the 18-month cycle peak over here, as discussed in previous market updates, to the peak that formed in early 2021. You can see that Sentient Trader is not positioning a 54-month cycle in the peak analysis at all. That is because even though it has found several 18-month cycle peaks, and it has found enough of them to count a 54-month cycle peak, positioning a 54-month cycle peak over here just does not make sense to it. And positioning a 54-month cycle peak over here, there isn't really quite enough data to do that with any confidence, so it is simply not positioning a 54-month cycle peak there at all. Nevertheless, it does achieve the analysis that I'm looking for, which is an 18-month cycle peak over here in early 2021, indicating that the recent peak in November, I think it was of only 40-week magnitude. So let's have a look at what we're expecting for the next year according to this analysis. And here we have it. And I think you can see that the composite model line is matching price action more closely in the past. That's another example of why sometimes it's not necessary to include more data in your analysis. Sometimes the positioning or the phasing of those longer cycles can muddy the waters a little. Sometimes it's better just to focus on the shorter cycles, and by shorter cycles I'm speaking about 18-month cycles and shorter in terms of this analysis, and we're getting a fairly good match between the composite model line and price action over the period of time throughout 2021, as you can see. So the composite model line here is telling us that price is now bouncing out of a 20-week cycle trough. As I've mentioned over there, we have our 80-day cycle trough in February. There it is. We have our 40-week cycle trough in April. There it is over there. But you can see that the general picture for Bitcoin is very much the same in this analysis. Even though the 54-month cycle did not form a peak, according to this analysis, either over here or over here, we have a very similar situation with a generally declining Bitcoin into the trough towards the end of next year or early 2023. However, I should throw a spanner in the works here. Because of the fact that this is the second 18-month cycle peak since the big peak in 2017, December 2017, the next 18-month cycle peak, which is this one over here, must also be a peak of a cycle that is not included in this analysis. That's a really important point. That is a 54-month cycle. So we need to add that information, which is not included in the analysis, the software is not considering it. We need to include that information in our own consideration of what is expected to happen. And what does that mean? Well, it's very simple. If the 54-month cycle peak still lies ahead of us, which is then expected to form in about October or November of next year, then in fact the move up to this peak is going to stretch a lot higher into that 54-month cycle peak. And so you have to be careful looking at the composite model line, particularly looking a year ahead. It's a little bit like driving down a misty road. We can look at the next few bends, but once we turn the next bend or two, we will get a better idea of what is unfolding. And it would not be a huge surprise to me if Bitcoin continues even higher. You can see some of the prices up here, huge numbers over here for Bitcoin. And that is certainly quite possible if the 54-month cycle peak lies ahead of us. So it's going to be very interesting to watch the first few waves forming into the early months of next year to see where that 54-month cycle probably lies in terms of the peak. I do hope that you found this market update useful and interesting. It was a bumper special, extra long market update for the end of 2021. I'm going to be taking a break now of the festive season, and I'll be coming back towards the end of January from my break and resuming our market updates to see what the cycles are doing in the markets. I wish you all a wonderful festive season and a fantastic new year, and I look forward to seeing you in 2022.